All right, so hello everyone and welcome along to this live webinar. And today we'll speak about deal analysis and how you can utilize Lendlord in order to analyze deals. And we have a special guest today. So Nick Hill, a real estate investor, and the host of one of the greatest podcasts and a mortgage agent. Nick, I will let you introduce yourself. And also we have Daniel Foch, real estate. I think you're with the same on the same podcast, if I'm not mistaken. Of course.
Yeah, we're co-hosts. Yeah.
Experienced property investor. So let's start. Perhaps you can introduce yourself, and we'll take it from there.
Yeah,
absolutely.
Sure.
Go ahead, Nick.
Well, Dan's the brains of the operation here, but I'll start off. Yeah, look, I don't have enough good things to say about Lendlord. But before that, hello everybody. Thanks for joining us. Excited to be here and go over a tool that I use probably on a daily basis at this point, whether it's analyzing a deal for our podcast, which has a deal of the day segment that we use Lendlord for, or an Instagram video, or realistically just looking for deals all the time for myself and my clients. Lendlord makes it so easy, and I hope that we are able to illustrate that today through this webinar. So thanks for having me, fellas. I'm excited to be here, and yeah, let's analyze some deals.
Sounds great. Daniel?
Yeah, my name's Daniel Foch, real estate investor and broker, and I co-host the Canadian Real Estate Investor podcast with Nick. Use Lendlord a lot, not just as a deal analysis tool, but also an analytical tool for uncovering markets. It allows me to calculate, like I do a lot of sort of micro market analysis for different cities across Canada. And it allows me to calculate very quickly, like to do the napkin math very quickly to get an understanding for how different markets are priced. So over the past 2 years in Canada, we've seen a lot of change in house prices, but also a lot of change in rents, and understanding what cities are performing better on a cap rate basis, based on, year over year, is important for me because I advise clients on a daily basis where they should start looking to invest or park their money. And so one of the things that I do is I put out just a single chart that I use Lendlord to analyze deals across the country. It basically shows a cap rate spread of properties available within any major metro in Canada. And so that comes out typically the day after Canadian Real Estate Association data comes out, which is yesterday. So I should have that chart updated shortly, but I use Lendlord to do that on a regular basis. It allows me to look at hundreds of deals coast to coast very quickly.
Sounds great. Thanks, Daniel. So if you have questions, by the way, feel free to put them on the chat and we'll try to answer as we go. And we have like a quick session in the end of the webinar for questions and answers. The agenda for today, I will start with a very brief overview about Lendlord as a whole, as a platform for property investors and landlords. Then Daniel and Nick, I will ask you for some tips, top tips for how to source properties, analyze, and then perhaps the analyzing tips we can keep them when we actually analyze properties. And Nick, I think you prepared 2 properties that we can actually use as a use case. One for rental, and then we also do like flip analysis. I will show you how you can review the prospect deal report, and perhaps some tips also when you look at Google Maps, what should you take into account. All right, so let's start. Let me share the app. So, 1 second. All right. So we spoke about deal analysis. I think this is a very important area on the platform. But on Lendlord, if you are an existing landlord on an existing portfolio, you can actually manage your existing properties, the entire data sets, and documents, etc., and cash flow on Lendlord. So for that, you will use the manage on the item, the manage area, and you have sub items in the menu. My portfolio, this is the place to manage all of your properties. We actually keep, I think, more than 100 data items on each property, and you have different sections, the general fields to put some details about the property, details about the ownership. Then you have the mortgage section to put the details about your mortgage, enhanced property details, some data about utility suppliers, on your insurance, if you have a second mortgage or a secure loan or short-term loan, you can track everything in one place. On my portfolio, you can apply different views. For instance, the equity view, I really like, very simple, just the address, how much equity I have in this property, and what is the current loan to value. And you can sort the table by just clicking on the title of the column. And you have a nice summary of your portfolio. You can also use the filters. So let's say that you have more than one owner in one Lendlord account. So you can filter the data based on the ownership that you entered for each property. And you can also manage different ownerships. So if you have properties under companies, you can also view just those properties. Another thing you can do is to review your properties on a map, on a Google map. And the performance view, we will touch it when we analyze deals, because you can also save your prospect properties and store them on my portfolio. And I think Daniel, you spoke about the cap rate. I think this is a great way to save several prospect properties and just compare the cap rate. So the performance view can let you know your current position in terms of net cash flow, what is the projection for the next 12 months, what you did in the last 12 months, and also some numbers for the long term based on your future assumptions. Then you have the My Tenants. This is the place to manage your tenants and tenancies. You can also manage your rent collection on the payment schedule page. I think that we will do a dedicated webinar just on this part, but I just want to give you a brief overview. And on the cash flow section, on the transactions page, you can link your bank accounts and then allocate the transactions, the income and expense transactions to the relevant property. It's a great way to keep your cash flow on track, but also a great way to track the performance of your properties. So on the profit and loss page, you can see the income and expenses for the entire portfolio. And of course, you can also apply filters here. So you can see it for specific property or subset of properties, etc. On the report section, you can generate P&L report, the breakdown per property, expenses breakdown, income breakdown, and also a tax report. The interactive report is something that I personally really like because it's a high-level overview on your entire portfolio. So you can see the current level of equity, the leverage of your entire portfolio, some information about the performance of your portfolio, and then you can see the top performing properties in different metrics and the worst performing properties. And if you stored prospect properties, you can also review them from the interactive report. And then you can just go property by property. If you think that the value was increased or decreased, this is a great way, a great place to just update the value. And you can see the performance of this specific property. And there is also ranking. So you can see how this property ranked relative to other properties in your portfolio and the monthly figures. So this is the managed side. Finance is something that is still under development, but we do have mortgages with HomeWise. This is our partner. So if you look for a mortgage, you can search here and apply online with our partner HomeWise. And then let's start discussing the invest part. In the invest part, currently we have rental analysis and flip analysis. Soon we will have also a BRR analyzer. So before we start with this, demoing this part, let me ask Nick and Daniel, let me ask you, what are your top tips when first to source properties, to find great opportunities, and once you find them, how you basically look on the investment? But we will do like a live analysis, so you can also speak about the analysis part on this part, but perhaps about sourcing, like especially these days, how you find great opportunities.
For sure. Why don't I start things off here, Dan? You know, I mean, it's a bigger question because you have to know which market you're looking in, but let's assume that you do know what market you're looking in and you're just looking on MLS. You know, it's pretty simple. This is why I love it, because you can get on, find a property, you know, literally go like one of the properties I pulled for us to look at tonight was in Kingston. I was able to find that property pretty quickly with a search on MLS, very simple search that just literally type in multifamily. You can type in some other stuff, but multifamily properties, pull up a one that looks half decent and plug it in. And then what I'll also do is, if I'm not too familiar, if I'm just doing an exploratory search, I'll pull up some other demographics of that location. So if I'm not familiar, I'll go and look at the demographics, the population, see what I can find, look at like rentals.ca, Rent Panda, or Zumper. There's tons of good information out there to figure out what a 1-bedroom rents for, what a 2-bedroom rents for, what property taxes would be in that area if that information is not available. So just do a little due diligence and you'll be able to fill out and populate most of the stuff you need to.
So for me, the big things I look for are markets that I would consider inefficiently priced. I think that's where you're going to get the most sort of risk protection. So the two biggest indicators of that are where the price is growing the least and where rent's growing the fastest. And you can kind of reverse engineer it from there. To find assets, you know, you can typically, I guess end users now, I'm making the assumption that most end users on the market now are sorry, most people in the call here are end users and not realtors, as an example. But if you're a real estate professional, you know, you're not going to like this advice, but if you're an end user, you know, because we have Zillow now and House Sigma and all of those things, you can see when a property is on the market and you can see when it's taken off the market and failed to sell. And typically the easiest way to find decent deals where people have already expressed an interest in selling their property is looking off the market. You're usually going to save yourself, you know, anywhere from 3 to 5% that would have been charged and went into the realtor's pocket by finding that yourself. And most people aren't going to take this advice. They're just going to go and find something on realtor.ca and end up paying that 5% premium. But typically you do save money buying off market if you do it well and if you know your product. So the big thing from my perspective is know your product, do a ton of research, understand what rents are and what prices should be, know the comps. And that's in a lot of cases where most people like to outsource that job to a real estate professional. So I guess the final piece would be, if you don't know what you're doing, find a realtor who does.
Good advice. Thanks, Daniel and Nick. So now let's jump in and start analyzing a few deals. So Nick, you sent me 2 properties that we can use in this webinar. Before you start, should we start with this one or the second one for rent, if we do like a rental analysis?
Yeah, whatever one you have this one open, so we may as well. And I think I also sent you a link to Zumper, which is pretty easy to figure out what those rents would look like.
Okay. So we'll take a look. So let me just fetch it. It will take 30 seconds. Okay. By the way, did you this like to get those properties something that you know this area, or like properties that you already looked at, or just for
Yeah, I mean, I'd spent quite a bit of time looking at properties and analyzing the markets in both Kingston and London. They're both pretty hot markets for investors, really well known to the investor community here. So I figured they would probably be applicable for the call.
Perfect. All right. So so we will start with the London one. Yes. Okay. So on Lendlord, I will go from the menu to invest rental to the deal analyzer. And the first thing you need to do is to start typing the address. So I will take the address from here. We use Google Map auto completion, so you can just start typing the address and it will auto complete it. Then you get also the zip code. And then the next thing you need to do is to put two data items, the purchase price and the expected monthly rent, and the platform will use its default, and then we'll start tweaking. So the purchase price, Nick, should we put this price?
Yeah, usually I just leave them as, especially if they're found on MLS, I like to leave them, and then once I have that initial pro forma done, I'll go back. If I don't like the cap rate, if I don't like some of the return metrics, I'll go back and play with it a little bit. Another good reason to know the market is you can go and look at comps. So if this is listed for $599, but nothing sold in the neighborhood over 550, and you think you might be able to get a deal, then you can go back and start to play with the numbers and see how that affects everything.
All right. And the rent for this property would be 1,700.
Yeah, so that's a 1-bedroom. I believe they were
Okay. All right, so now we'll start tweaking the data. I think that the negative cash flow will be, I think, mainly because of the mortgage. But before we go there, so we can play with the purchase price and property value. So if you think that the property actually valued in this amount and you are able to purchase it in a lower amount, on the deal analysis, you can put it here, and then basically, I think it will impact your ROI for this first year. In this example, would you do any change between the purchase price and
sorry, it's a duplex, right? So just the one side is 1710 because it's a 1-bedroom, and then the other side is actually would rent for about probably 2106. So let's add that 2106 in there to the 1710.
Yeah, divided by 12. 2106.
So 3816 is what you'd be getting a month.
This amount. Yeah, 3,800.
Yeah.
Okay, perfect.
Yeah, those returns look a lot more appetizing.
Yeah.
All right, land transfer tax. So basically, we calculate based on the region. It makes sense for you, the 8,473. In this case, we take it as not non-first-time home buyer. Then improvements. Are you going to do any renovation, furnishing, or anything else that's relevant to improvement for this property? Or are we just going to let it out?
Likely, by the looks of it, doesn't look like it needs it. I like to run my numbers very conservatively and like to have some cash lying around for any kind of CapEx that pops up. So, and that's capital expenditure. So something large like a roof or anything like that, or some utilities. So I usually put, depending on the cost, I usually put about 10,000 there, just as a fail safe.
All right. By the way, a new feature that we introduced, it's part of the premium plan. I will show you that when I have like a demo account with the premium plan. It's generating works plan. So basically, you can actually add all the works that you're going to do for this property and the cost, and also the timeline. So when you're going to start the work, when you're going to end the work. On the UK, we also operate in the UK. when you apply, for instance, for bridge finance, hard money loan, you need to provide the plan to the lender. So it's a great place to do it and basically generate the report. Okay, so for this property, we'll put like as a buffer 10K. Then we have closing costs. How much usually you will pay for legal fees, appraiser costs?
Probably legals, I'd probably put 2,000 to be conservative, but typically 1,500. Appraisal would be let's say $600. Title insurance is built into the legals there. Property insurance probably $2,000 a year, and then land transfer I think is automatically calculated, but I think it's about just shy of 9,000 for this property.
Okay, this is the municipal land transfer.
Oh, so there wouldn't be any extra there. Yeah,
Okay.
there's no, because it's in only Toronto, I think, is the only municipality that has municipal land transfer in Canada.
Right. Okay, good. Okay, so basically now after we filled this box, we have the total costs to purchase this property, including the taxes and the refurbishment and closing costs. Then I would go to the cash investments and the loan. Let's start with the loan. What is the max loan to value we can achieve these days?
On a rental, probably 80% is going to be the max you're going to get. And maybe it's worth looking at the cash on cash return at that. But I would typically say, if you're a portfolio investor, you're probably going to be in the 70s. So probably 70.
All right. By the way, there is a difference between the deposit that you need to put down for the mortgage and the percentage of the cash investment, because the cash investment takes into account the entire purchase cost. So you will need more cash to pay your the land transfer tax, the refurbishment, and the closing costs.
Yeah.
Okay, so if we take 70% mortgage, would you take it for 30 years, let's say?
Your rate would be you'd probably get a 25-year AM on that, and yeah, you'd have a rate hold for a 5-year term. So each 25 is good. And probably the mortgage rate, I would probably put 5.5%, I think right now. I don't know.
Yeah, I've been
Nick,
using
maybe
5.5 or 6 even, just again, just to pad everything a little bit, right?
Yeah, makes sense. I think the repayment method will be principal and interest, yes?
Yeah.
Okay. And
Yeah, we don't want to be doing interest only stuff, not yet.
You know that in the UK, I think the vast majority of the, we call it the buy to let deals, are based on interest only.
It's crazy.
Oh yeah, you pay just the interest. And then, the cash on cash will be higher because the net cash flow basically is higher, but your equity is not increasing because the mortgage actually stay, the amount of the mortgage stay the same. But okay. Some mortgage fees that I believe you will need to pay. I don't know, let's put 2,000 or 5,000 or what?
Yeah, usually I leave that part blank, usually unless it's like a B lender and there's a lender fee or a broker fee. But if you're going to an A lender, there's usually no additional fees on top of that. So likely leave that blank.
Okay. And mortgage insurance?
We've got a good enough loan to value that we don't need it.
All right. Okay, so now let's review again the metrics of until now. We will still need to add them the monthly operating costs. We look at cap rate of 6.5-ish and cash on cash of 3%. What are there property taxes for this property on an annual basis?
It should be in the listing there, Nick.
Yeah, it isn't. So this is when we start to get creative.
Well, I can just pull the mill rate there.
And
just shy of 1%. So you're looking at $5,000. Worst case scenario, $5,000 a year.
all right. So if we get 1%, it's around 6.
That would be probably twice what it's actually going to be. So
Yeah, I was gonna say it's probably coming in below $4,000. So even if you want to just put 4,000, sometimes it's not as simple as just a percentage of it, but
All right. Okay, monthly operating expenses. Are you going to use the managing like a property manager to manage a property?
usually with stuff this like, again, it's a really subjective question to the person who's looking at this, right? If you have a property management company that's already up and running, and you know the cost to add another door. For instance, Dan and I have a property manager. Every time we add a door, it goes up, another $150 a month or $100 a month. So totally subjective. If this is your first property or your second property, I would recommend not having anyone else manage it, because that very valuable cash flow is going to be going to someone else, dealing with the headaches that you should be dealing with as you learn how to be a landlord. So usually I don't put anything for the management fee, because up until, maybe a year or two ago, I was doing all my own management. I do, however, definitely add some stuff for utilities, even though preferably the stuff that people are buying is separately metered or the tenants are paying utilities. But I always like to just throw some kind of bulk number in there, whether it's, depending on the size of the property, maybe $250 a month. If it's a sixplex or something larger, then that varies. But for something like this, I think that's likely safe and probably, again, a bit conservative.
All right. Landlord insurance on a monthly basis.
Yeah, again, something low. I mean, you can $25, $50.
Okay, let's do 40, like the average. Like in between maintenance.
Yeah, and then maintenance, I usually, that's just ongoing random expenses. I would just, again, put maybe, $150. Again, totally subjective. Once you see the property, if there's a big driveway that needs snow shoveling, that the tenants aren't able to do it or whatever, you'll know all of this stuff when you actually have the property to look at and you do that deeper dive.
Yeah, I think it makes sense, like when you analyze the deal, to be more conservative, and it's better than to be surprised after that.
Yeah, the days of liberal.
Yeah, we're learning. I think a lot of people in the market are learning that the hard way right now after modeling their deals with 10% year-over-year appreciation
or 2% interest rates.
Yeah.
Okay, so now let's speak about the long-term assumptions. Exactly. So here basically we have 4 data inputs. One is the annual property appreciation, and this is an average. So you need first to decide the holding period. The default is 10, but we can put 20, if you want to analyze the deal for 20 years. So you tell me what you prefer, like for this use case.
Yeah, usually with something like this, I think a 10-year hold is probably a good standard to abide by. And I love this long-term assumptions piece right here. Annual rent appreciation, I always add that in as an extra 2.5%. That's legally what most people in Ontario here anyways are allowed to do. There's obviously exceptions if a building was built after a certain point, but standard stuff and probably what most of us are going to be buying would be about 2.5%. Annual inflation, that's a hot topic right now, so we can play with that if we want to. And then annual property appreciation, Dan, help me remember. I can't. What is it? The average? It's like 6% is the average.
6.11% since 1984.
Yeah, so 6.11. Now, again, I like to be conservative, so I usually put 3 or 4%. And then I really do enjoy the occupancy rate percentage as well, because there's some stuff like London and Kingston, both the deals we're looking at, that occupancy is going to be 90 to 100%. It just is. Then again, you'll analyze a deal in let's say like an Edmonton or Saskatoon or a smaller secondary or tertiary city or town. And, you watch the numbers change as you drop that occupancy to, a 75 or an 80, fully anticipating it's going to be harder to get some people in there.
Yeah. Just like for people to understand the occupancy rate, like let's say if it's 92% means like 1 month every year for the next 10 years, the property will be empty with no tenant inside. So so 92, yeah, it really depends on the area. For this specific property, you would put 95 or higher?
Yeah, I mean, I think 95 is a safe bet.
Yeah, like I mean, practically most Canadian cities have below 1% vacancy in multifamily right now. But you know, for simplicity's sake, and again, ease of conservative underwriting, which we like to do, and make sure that people have downside. You know, set the expectations low so that you're very happy with your asset after 5 years, rather than upset that it was vacant for 1 month.
And that opens up a whole nother discussion about waiting for the right tenants. I know that landlords hate to see a unit empty. Trust me, I do as well. But it's much better to let something sit empty and wait for the right people to come along. Otherwise, you might be increasing that occupancy meter, even though someone isn't there, because you're just not getting paid.
Yeah. All right. One thing you can do in the long-term assumption is to use the what if scenarios drop down. And here you can set up different scenarios. So the default one is what we just entered. Then we can edit the best case scenario. So let's say occupancy rate 100%. You know what? Even best case, I would put like 99. Property appreciation 8%. Would you buy, by the way, take it even higher on the best case scenario? 8 makes sense for you?
Yeah, I enjoy some wishful thinking. We may as well.
Yeah. I mean, you could put annual rent appreciation, since both of these properties are in Ontario. I'd put it at 2.5% because that's what we're legally allowed to inflate rent at.
So it's at
2.5, yeah.
2.5. This is the best case scenario, yes?
Well, that's the only scenario. I mean, I guess like there are other cases where you would have a turnover, or if the unit's built after 2018, you can increase by whatever you want. So maybe the best case would be like a 4, but base case would be, or worst case would be 2.5.
All right. Okay, and then the worst case scenario, let's see, occupancy 92. Did you even take it lower, or you keep it 92? Let's keep it 92. Property appreciation. By the way, would you put like negative, like in the worst case scenario, would you put like even negative appreciation over like average in the next 10 years?
I would say if it was a 5-year outlook, I might say, but 10 years, I think you'll be okay in the fullness of time.
Okay. All right.
You can put even 0. Like I think 0 would be a worst case for most Canadians, right? Most people expect prices to go up.
Okay.
And I would actually, just as a point of reference, I would say to most people, if your deal doesn't make sense without capital appreciation, it doesn't make sense. So
exactly, you can see that, without capital appreciation, the metrics looks very bad, 3.35 IRR for 10 years. But with property appreciation, you can see that the long-term return, even if the cash on cash for the short term, it's not so high, I would say the cap rate looks quite good, and in the long-term metrics also look quite good. And the default, perhaps, I don't know, perhaps we were like too conservative. The standard, sorry, we did the start. I'm not sure like where we put the property appreciation. So let's edit now. What will be the property appreciation you predict like most likely to be? Let's say.
Yeah, I mean, it's standard. I think we can, if we can leave it at 6%. That's been the standard appreciation metric for Canadian homes for like the last couple of decades. So not there at the moment, but likely to end up back somewhere around there.
All right, and I will put 95 occupancy rate and 2% that's a rent appreciation. So then also with the standard, you get the metrics looks quite good. So okay, so basically after you enter the long-term assumptions, you can start reviewing the metrics. Do you have like anything to say? What do you think about this deal? Would you buy this property?
I probably wouldn't personally.
Why?
I mean, it's not necessarily my cup of tea, but typically, we're looking for opportunities that are more cash heavy, so cash on cash heavy, and in order to do that at a 70 to 80% loan to value, typically 70% loan to value, we're purchasing, you need to be at a cap rate of usually around 7%, between 6 to 8% ideally. So I just think, I would personally rather go a little bit further out, maybe I'm trying to think of maybe to Windsor as an example, and push to get a Windsor or Sarnia and push to get a higher cap rate, especially in a market where I don't think we're seeing capital appreciation for a while.
Okay.
Nick?
Yeah, I mean, I tend to be a bit more bullish than Dan. I don't mind the deal. It's definitely not something that jumps out at me. I see some stuff on here when we're analyzing deals, and it's a couple provinces away, and Dan and I are trying to book a flight and figure out how to get out there and purchase it because it's so good. Double-digit cap rates, great, long-term metrics. It depends. I think it depends on if that's your area. Maybe this is something that comes up a lot as well because we can't know everything, but sometimes we'll find a great deal and it'll be in a bit of a sketchy area. By the looks of it, this is a pretty good area. It says so in the description. Maybe there's a chance you can bring the rents up a little bit, but even at the best case scenario, I like to see duplexes at least, the cap rate starting with a 6. We're not there yet. This looks almost more like a deal closer to the GTA where, 5 caps and below are kind of the standard. So it depends on what the strategy is here and what the type of investor, their risk tolerance and all that. Overall, not a deal I would do personally, but is it a deal that someone could and someone should? Then, yeah, I think so. It's not bad.
All right. Next thing, by the way, to save the property, this is a prospect property. The way, if you want to view the metrics again, go to my portfolio. On my portfolio, I would start with just select the existing properties, and then on the prospect drop down, you will have all of your prospect properties. And this is the one that we just analyzed. So you can see the value, the rental income. And if I switch to the performance view, I can see the metrics. Now, let's say that I analyze another prospect property, I can add, and then I can compare 2 different deals. Let's see if we have the cap rate here. You can play with, if you click on manage views, go to the performance, you can add or remove columns. So you can actually, we have the cap rate. So you can actually customize your views. You can also order the columns. Okay, and from here you can also go back to the deal analyzer. Another great thing is the prospect report. The prospect report, you can see the property over map. We'll speak about it in a sec. You can upload photos. You can see the summary of the deal. You can see the metrics here and some charts about the development of your equity over the years based on the long-term assumptions, and also the development of your cash flow. And you can also see the holding period breakdown in terms of equity and also a net operating income. Daniel, Nick, do you have like anything like when you look at the Google map, like something that you can learn out of it?
I actually find it's almost more helpful to just share a deal analyzer on TikTok and let people tell me that it's in the worst neighborhood in the world.
Okay.
But no, I mean, I typically look I think I probably cater to a different type of tenant than most people want to in investing, but it works well for us. But I have walkability to transit, walkability to grocery stores, et cetera, so that people don't have to be car dependent. And then also, if I'm catering to, we typically want to have older tenants, seniors who, value the landlord and tenant relationship a little bit more, and in a lot of cases take pride in paying their rent, and also have more stable sources of income, so ODSP or pension or whatever it is, CPP. So in that case, walkability to a hospital, medical centers, et cetera. So those are things from an aerial perspective where you can analyze the neighborhood context, and that typically helps.
All right.
Yeah. The only thing I'd add to that is I do exactly what you're doing right now. Google Walk Around or a Google Earth Story is such a handy tool. As investors, I'm sure we all have our own rating systems, and if you don't, you will at some point as you start looking at neighborhoods, and whether it's A, B, C, or 1, 2, 3, 4, 5, whatever, you'll start to rate neighborhoods. So just walking around, you get to see the feel of the neighborhood. Is there industrial close by? Do people have trash on their front lawns? And again, everything else that Dan said, right? What is, where are the schools? Where are the universities? Who is this going to be catering to?
Yeah, great tips. All right. Let's see. I think that we have some questions in the chat. Okay, so Jeff is asking, I might be jumping the gun, in case it comes up later. Okay, I was wondering if there is function for analyzing pre-construction, like 5-year build time until closing, and then 5-year post closing with rents. So it will be something that we are now working on. It will be part of the BRR analyzer, but it's not available yet. Perhaps you can do it like in two different sessions. Daniel, you already answered. Okay, so now sorry, now just like, okay.
No, yeah, it's all good. That is a great idea, though. It would be cool if we could build in a pre-construction tool there. A lot of people in the Canadian market do invest in pre-construction. So,
okay, yeah,
we can chat with you about that and sort of what that would look like from a model perspective. So
yeah, when will be the BRR? I think that we will also discuss this as like a next step for that. But okay. Jennifer says local Airbnb reviews can also give neighborhood insights. Thanks. Okay, we actually almost run out of time. If you have 5 more minutes, we can just touch the flip analyzer, if that's okay.
Yeah, we can quickly go through that. Yeah.
All right, so the flip analyzer, it's very similar, but here basically what we do is just we will enter the purchase details, the loan and the cash investment. The loan here, you can speak about like how it goes in Canada, but usually if you will take a loan for a flip deal, you need some kind of in the UK is bridging finance. So it's a short-term loan. Usually it's more expensive. The interest rate it's higher than a regular mortgage, but it's for short term. And then you just need to put the monthly holding costs and the sale details. And then you can see based on the length of the project, how profitable is going to be based on the ARV, this basically the price that you will get in the end of the project. Because in flip deal, you sell the property in the end of the project. The BRR analyzer that we will develop, you will be able to analyze what happens next if you rent this property after the refurbishment. So Nick, perhaps quickly we can take the Kingston property, and you think it's okay? It's good to take this for a flip?
This one was more of a rental analysis. This would actually probably be a pretty good one. So for anyone in the audience that wants to do this, I'd recommend taking a crack at this one. Triplex with a 4-bedroom, a 2-bedroom, and a 1-bedroom. So you've got a big spread of rents. Go check out how much they rent for and plug it in. I'd recommend everyone go and try to do. Oh yeah, thanks. So it's in the chat, everybody.
Yeah. All right.
Unfortunately, flips are getting tougher and tougher this side of the world right now with costs going the wrong way and the price of debt going the other.
Yeah. So I think that we can just speak in general, if you can start with typing any others, put the purchase price, and then start to break down the improvement costs. But just for this example, let's say that we're going to do improvement of 30K, put the closing costs, 3,000 total, the transfer tax, and then what would be the rate for the interest rate for a hard money loan or bridge finance in Canada?
Yeah,
probably 12.
Yeah, I was gonna say be similar to the stuff you're describing in the UK. We're likely looking in the double digits, especially if it's for a 6-month term or a year or less. Realistically, it'd be 12 or if not more.
Or so they put 1% a month. Okay, like this around like 12-ish. Let's take the LTV even to 70%. Then you will need to put down 63K. And then I would put just a buffer on the holding costs. And just for this example, let's say that you bought this property 100, you performed improvements, 30K, and then you sell it 170. It doesn't make sense. I don't know. Do you have agent? Yeah. What, Nick?
I wish we had deals like that here.
Agent commission, you would pay 1% like for sale, or more than that?
2.5.
Yeah. Okay. Perhaps we should change the default here.
And that's per end. So I'd probably make that 5%.
All right, and we can put the buffer. So what I like in the flip analyzer is that you can see that, and I think perhaps you can say a few words about it, the importance of the timing. So the length of the project is so important because the debt costs will increase and then it will cut your profit. So you can play with this bar and see if it's 8 months, what is going to be your profit. But if it will length 14 months, it will, impact your profit. Any words about like flip deals? So you said that it's not the best time to do it, but
a couple quick things about flips, I guess. I have a background in construction. I always would like to add 10 to 15%, if not more, on both the budget and the schedule, fully anticipating that things go wrong, things get delayed, especially in today's day and age. The flip is you really have to do the buy right. It's all about buying right. Unfortunately, the numbers in here, 100,000 purchase price, sadly don't make sense. But we do know people that are flipping across the country that are doing quite well. It's just seemingly in the more expensive markets, it gets harder. Another thing I'd recommend anyone looking to do a flip is have multiple exit strategies, right? Don't just go in and run these numbers and be like, okay, great. I'm making 30, 50, 150 grand on the way out. look what happens if it doesn't sell and how much you could rent it for and how much it would be to, you know, even convert it into a duplex, or how much it would be to, you know, short-term, medium-term, Airbnb, run all those numbers. And I know you can do some of that in here as well.
Yep. All right. Okay. Thanks, Nick. So I think that's it for today. So if someone has have any questions, please feel free to ask. But if not, any last words from you, Nick and Daniel?
Not really. No. If anybody wants to, if anybody's a real estate professional on here and wants to join us after, we're doing a Twitter space for realtors, just called the Realtor Roundtable. I'll just maybe post the link. It's literally starting in 7 minutes. So if anybody wants to just talk about the market, we do these on a monthly basis, and would love to have any real estate professionals or anybody who has questions about what's going on in the real estate market on there. And Lendlord actually helps us put those on as well. So you'll typically see them on there as a co-host on Twitter. And this one's going to be hosted by Real Estate Magazine, which is Canada's real estate publication for realtors.
Yeah, I guess the only thing I'd add is if anyone does have any questions, Dan and I are pretty easy to get a hold of. If you want us to walk you through this or you know, help you look at a deal, you know, it's pretty simple to do. So just reach out to us whatever way you see fit, and we'll make sure that you're taken care of.
All right. Thank you very much, Nick and Daniel. It was very helpful. And thanks, everyone. Feel free, if you haven't signed up yet, to sign up to Lendlord Register for free and start analyzing deals. We are available on this chat. We are trying to answer quickly. So if you have any suggestions or if you want to report any bugs, so feel free to use this chat box. And yeah, so that's it for today. Thank you very much. Have a great evening. Thanks.
Thank you.
Thanks, everybody.